Good afternoon, everyone. We're going to be discussing pending carbon costs in Canada today. It's a topic that's on everybody's mind right now. Just a little bit about who 360 Energy is. We work with clients in the industrial, greenhouse, and mush sectors for the most part. And we work with customers who want to be proactive in managing their energy consumption and costs on a sustainable basis. And part of that, of course, going forward is going to be carbon costs as well. It's my pleasure to introduce James Williams, who's going to be our presenter today. He's our energy analyst and resident carbon expert. He was our primary account representative under Ontario's previous cap and trade program, while that program existed. And in that role, he managed cap and trade compliance for our participating customers. James has been really studiously following the federal carbon backstop program and how it's being applied to Canadian customers, and has compiled a great deal of good information for everyone here today. Today's presentation will take approximately 1 hour. It's going to cover off the current information that's available regarding how the federal carbon backstop will impact customers in provinces that do not currently have an existing carbon pricing, which now includes Ontario. We'll start off by discussing the program and how it will apply and work for voluntary and large carbon emitters, which it's going to contain some dense information. And because of that, we're going to take a short break following that section to allow for questions. And then we're going to finish off the webinar discussing how carbon tax will apply to other customers, exceptions, and other means that all other customers can take to mitigate their carbon costs. As there's a good deal of information being provided in this webinar, we will be recording this presentation today, and it will be made available on our website afterwards.
Okay, yes, I'm James. Presentation will cover a lot. It'll be very in-depth, and it'll cover a wide variety of aspects of the federal carbon program, including the background, how it came about, the goal of the program, of what the options are for customers in terms of how they get billed, pricing system, which is one option for large emitters, for emitters under a certain threshold, so generally smaller businesses, and some actions that customers can take to mitigate their costs. For emitters under a certain threshold, so generally smaller businesses, and some actions that customers can take to mitigate their costs. So we're going to start off with a question. This is just to get you thinking about the relationship between energy usage and carbon. The question is, approximately how many GJs of natural gas emit 10,000 tons of CO2 equivalent? And you've got 100,000, 150,000, 200,000, 250,000, or 300,000. And again, this is approximately. Obviously, it varies a little bit, but nice round numbers up there. So think about that for a second. The other thing we'll want you to think about is, what are your emissions at your facility, or if you oversee multiple facilities, what are your emissions at each facility you oversee? We won't be quizzing you on that at the end. That's just something that's important for understanding how this program will affect you, is understanding what your emissions levels are. And if you don't know the answer to that question, we'll help you get to the point where you should be in better position to figure out. So we'll start off with a review of the history of the federal carbon backstop. So it was announced generally the Pan-Canadian Framework on Climate, which was announced in December of 2016. The plan included progressive carbon pricing starting at $10 per ton in 2018, increasing by $10 a ton every year up to $50 a ton by 2022. The technical framework for the federal backstop was released in January 2018. The Greenhouse Pollution Pricing Act was passed on October 23rd, and the registration for the output-based pricing system, which is the program for large emitters, opened on November 1st. Now, on the right here, you'll see two dates in big bold letters. That's January 1st, 2019, and April 1st, 2019. So the January 1st date is when the Ontario output-based, or the output-based pricing system was effective. That means for customers that are covered by that program, that the first compliance period will be from January 1st, 2019 to December 31st, 2019. The carbon tax portion is the portion that affects everybody else, and that comes into effect on April 1st, 2019. That's when gasoline, natural gas, everything will become that little bit more expensive to cover the carbon costs. And the federal carbon pricing backstop does not apply to every province or territory in Canada. It applies only to provinces and territories that don't have their own program and that either request the government apply the program to the jurisdiction or don't request. They get covered either way. So we'll look at a few of the jurisdictions in Canada that have their own carbon pricing programs. The carbon tax portion is the portion that affects everybody else, and that comes into effect on April 1st, 2019. That's when gasoline, natural gas, everything will become that little bit more expensive to cover the carbon costs. And the federal carbon pricing backstop does not apply to every province or territory in Canada. It applies only to provinces and territories that don't have their own program and that either request the government apply the program to the jurisdiction or don't request. They get covered either way. So we'll look at a few of the jurisdictions in Canada that have their own carbon pricing programs, and some that will be covered by or all of the ones that will be covered by the output-based, or the federal carbon pricing backstop, sorry. So BC has had a carbon tax since 2008, and the carbon tax in BC is currently set at $40 a ton for 2019. Alberta, they've had their carbon tax since 2017, and it's currently set at $30 a ton. Both of those are currently above the federal mark of $20 a ton, so the government's not stepping in, they're already doing their part. Quebec has a cap and trade system. The last auction price for that was $20.27, so very comparable to what the new carbon tax price will be. And actually, it's very similar to those who were in Ontario's carbon tax or cap and trade program, the cap and trade program we had. In fact, they were linked for a brief period, but yeah, in cap and trade, the carbon price is set by markets fundamentally. So Newfoundland, Nova Scotia, and the Northwest Territories are all implementing their own carbon tax programs that meet the federal requirements and that have a base price of $20 per ton for 2019. They're all coming into effect this year. So there are 7 jurisdictions that are covered by the federal carbon pricing backstop. That is the carbon tax and those output-based pricing systems. So PEI, the Yukon, and Nunavut have all opted into the federal program. So they'll have a carbon tax price of $20 a ton plus the output-based system. What opting in effectively means is that the federal government will give those jurisdictions the proceeds from the carbon tax and allow them to distribute them as they see fit. For Manitoba, New Brunswick, Ontario, and Saskatchewan, they're all covered by the federal program despite their reluctance or unwillingness to put a price on carbon. And so that means the federal government is the one who gets to distribute the proceeds of the carbon tax in those jurisdictions rather than giving the money to the province or territory to distribute. Again, we've mentioned these two programs, the output-based pricing system and the carbon tax. The output-based pricing system, as mentioned, is really designed for large emitters. So there's kind of 2 subparts to that. One is mandatory participants, and those are customers or facilities over 50,000 tons CO2 emissions per year, and that undertake a covered primary activity, and they must participate in the output-based pricing system. Now, any facility that is over 10,000 tons CO2 equivalent and that undertakes a primary covered activity or an eligible activity may opt into the output-based pricing system. They have that choice. They are not required. So again, that's for large emitters, everybody over 50,000 tons and effectively over 10,000 tons. Facilities that don't meet the threshold or that are below the 50,000 tons and choose not to opt into the output-based pricing system are covered by a blanket $20 per ton carbon tax that'll be passed along to them by fuel distributors. Although there are some exceptions that apply to that, and we'll look at them in more detail when we get into the carbon tax portion. So we'll look a bit more detail now at the output-based pricing system. So the government has created specific production standards for certain large industries. We'll get into a bit more detail on in a couple of slides about what those industries are. But they're primarily chosen because of their high emissions and high levels of trade exposure. Effectively, the carbon tax would increase their costs very significantly, and there is a very significant risk that competitors in jurisdictions without the carbon tax would effectively steal their lunch and replace them because the cost would just be too substantial. So those are what we call emissions-intensive trade-exposed industries, and we'll get into a bit more detail about that as well. So facilities which do these activities report on their emissions and production levels to the federal government through Environment Canada. They file reports that contain both production data for whatever the output-based standards are, and emissions. Effectively, the government has these output-based standards that say at this level of production will give you credit for so many emissions. It's typically based on either 80% or 90% of the industry average for those industries. Customers which have more emissions than they do credit pay the difference, and customers that have fewer emissions than the standard get credit for the difference. So we'll look first at some of the activities, and then we'll look at an example of how it applies. So this is a list of primary activities. A large part of it has to do with natural resource extraction or development. So you can see different types of mining, different fossil fuel production or processing. So processing natural gas, transmitting natural gas, production of grain ethanol for fuel. So a lot on the very carbon-intensive industries in terms of production of carbon, mining of coal, mining of metals. You can see the production of activated carbon from coal. And then some more heavily industrialized activities such as the production of steel or production of iron ore pellets. One mentioned on here is the production of vaccines or production of bricks. So some fairly heavy industry processes up there. So this is the list. We had to kind of do short form definitions for each item just because there are a lot of them. We've got the link at the bottom there that shows you what those activities are and what the output-based standards are. So that's effectively for example, ton of cement produced, how much credit you get against which you can compare your emissions. So our example is not cement. Our example is a natural gas generator, because the production of electricity from fossil fuels is one of the covered activities. So if you take an example of a natural gas generator that produces 150 hours in electricity in 2019. Well, the output-based standard for electricity production is 370 tons of CO2 equivalent per gigawatt hour of electricity produced. So if you look at that 150 gigawatt hours times the standard, that 370 tons, you get a benchmark for this site of 55,500 tons CO2 equivalent. So in scenario one, if the site actually emits 65,000 tons in producing that electricity, they have a balance of about 9,500 tons CO2 equivalent. That's how much CO2 they'll actually have to pay for, because they were worse than the benchmark, so they have to pay the difference. So this is based on a price of carbon of $20 per ton, they would have to pay $190,000 for their 2019 emissions. Now, in scenario 2, if they were actually better than the benchmark and they only emitted 51,000 tons CO2 equivalent, they would have a balance of 4,500 tons in credits, and so they would get credits from the government for those emissions that they didn't produce under the benchmark. Those credits can then be used to pay off future emissions owing. So if you produce under the benchmark in 1 year and above the benchmark in the next year, you can use those credits from the 1 year to offset the difference instead of paying that flat $20 per ton carbon tax. So again, you can see organizations that owe emissions can pay in 3 ways. One is paying the carbon price for the year the emissions were produced. Another is using existing credits from previous years, or you can purchase them. So the federal government has set aside provisions for effectively market participants to fill in the gaps here. So people who are not covered by the regulation in terms of their operations, but who are coming in to basically trade in credits. Recognized compliance instruments are not just the kind of voluntary carbon offsets you buy from, say, when you're buying your airplane ticket, that you add the extra $3 onto your airplane ticket and it covers the carbon. These have to be, they talk about generally allowances from the Ontario offset program, BC offset program, or Alberta offset program will be covered or will be allowed to be used. Otherwise, they haven't actually confirmed what the different options are in terms of other compliance offsets. Again, then emissions that have fewer, or organizations that have fewer emissions than the standard get credits, and these credits can either be stored for up to 5 years from the calendar year that they were created, or they can be sold to other facilities. So there is an incentive for organizations covered by the output-based pricing system to reduce their emissions below the benchmark so that they can effectively turn it into a form of revenue generation. And so there is a benefit to organizations that do emit below the benchmark standard. So if you, as a gas generator, emit, say, 300 tons of CO2 equivalent per gigawatt hour instead of 370, you can sell the difference to other companies, or you can store it for future use if you think that's going to change. So we'll look at the 2 types of participants now. So the first type of participant is a mandatory participant. There are expected to be about 133 mandatory participants across the country. By the looks of it, about 100 or so of those will be Ontario, and the rest will come from other jurisdictions. The mandatory participants are those who do a covered activity. One of the activities on the list we looked at a few slides ago. They also emit over 50,000 tons of CO2 equivalent in either 2014 or any subsequent year. So I believe that if you've emitted 50,000 tons any time in the past 5 years, you have to sign up as a mandatory participant, unless you can prove that you haven't emitted below that for a certain period of time. They must register before April 1st, 2019. That is a registration deadline. It's a requirement. There's 2 places they have to register. In Environment Canada's Single Window Information Manager, which is called SWIM, and with the CRA to receive an exemption certificate. The exemption certificate effectively allows them to not get charged the carbon tax on fuel when they're using it, but instead get charged it at the end through that output-based pricing system, as mentioned, and so that they aren't being double charged for fuel. Now, most people above in the mandatory participation range should be very much acquainted with the single window information manager. That's the process through which anybody over 10,000 tons must report emissions currently. So there is just a few steps in there. We won't get into that much detail on this webinar, but we do know the process, and we can help people with that process as required. And again, those reports that they provide must contain both emission data and production data. The production data and emission data for every covered activity and everything at that facility, rather than just the specific covered activity. It must cover January 1st, 2019 through December 31st, 2019, which is the compliance period. It must be verified. The reports must be verified by the same date as the emission reports and production reports are due. So they're due June 1st, 2020, and you have to have both the reports and the verification of those reports provided by that date. And then payment, if you have any outstanding payment, you need to send it to the government by December 1st, 2020. Now, the second category of participant is a voluntary participant. So they are above 10,000 tons CO2 equivalent in 2017 or subsequent years. So if you file your report for this year, for 2018, and you're above 20,000 or 10,000 tons, that'll allow you to qualify, or if you were above it when you filed last year's emissions report. And again, any customer or any facility above 10,000 tons in Canada must file emissions reports in the single window information manager. Now, voluntary participants, there is a bit of flux around who qualifies as a voluntary participant. So if you do one of those covered primary activities mentioned on that list, so the mining, the resource extraction, if you make bricks or vaccines, if you do one of those things as your primary activity, then you can qualify, you can choose to participate in the output-based pricing standard. Now, they've also added in this new possibility. They're called eligible activities. And effectively, anybody can apply to have their industry activities qualified as an eligible activity. This is a bit of a catch-all to make sure that smaller trade-exposed companies are not missed. So voluntary participants in trade-exposed sectors may request that those sectors be added to the regulation, and then any activity associated with those sectors become eligible activities. So, for example, if you're manufacturing certain types of plastic and you think that there's a big risk to your business from the carbon tax, which you would be paying otherwise because you don't qualify, then you can actually you can apply to get it covered in part or in whole. So we'll just take we'll just finish off the slide, then take a quick break. So the voluntary participants may register at any time. They don't have the same April 1st, 2019 deadline that mandatory participants have, because they aren't required to participate. They don't ever have to apply if they don't want, but they will start paying the carbon tax if they don't apply along with everyone else as of April 1st. It's the same process for applying for whether you're a mandatory participant or voluntary participant. And the first compliance window for voluntary participants basically starts the moment they enroll and goes until December 31st, 2019. So if you enroll after April 1st, you'll pay the carbon tax up until you actually enroll, and then that from that period on will be your first compliance window. Take a quick break just to see Is everyone following along? Anyone having any further technical issues?
Or any questions just to recap on some of this, because it's quite in depth.
This is G here. I have a quick question. The April 1 and the January 1, what is the difference? What we're doing?
Okay, so the April 1st is for the carbon tax. So that's when the cost of natural gas and gasoline increases and other fossil fuels increase as a result of the carbon tax. January 1st is for mandatory participants because they don't pay at the time and they have to do reports. Those reports will have to cover January 1st to December 31st. But they don't have to be published until June 1st and then paid until December 1st of 2020. So there is that fairly substantial lag, but it will be covering a slightly larger period than the carbon tax.
Thank you.
Any other questions before we resume? Okay, we'll have another opportunity
for questions shortly.
Yep.
Yep. Okay, so for voluntary participants, this is, as mentioned, still very much in flux, but there is a proposed amendment to the policy regarding voluntary participation in the output-based pricing system that allows potential voluntary participants, so anybody above 10,000 tons CO2 equivalent, to request that their sector be added to that list of covered industrial activities, because they are either in a medium or higher emissions intensity trade exposure category, and we'll be letting you know what those how that's calculated in the next slide, or because their sector is at risk of carbon leakage. So again, carbon leakage is where, because of the impact of a carbon tax, a business's production is moved to a different jurisdiction that doesn't have the carbon tax. So, for example, if an auto manufacturer, because of the carbon tax, moves the production that would be in Ontario down to Ohio, where they don't have a carbon tax, and where it might actually be worse for them to be producing in terms of electrical generation pollution. So to prevent businesses from relocating and actually creating just as many emissions or even more emissions, they have the kind of options to limit the impact of carbon tax on these certain industries. And again, this proposal is still a proposal. It hasn't been finalized. It is open until February 15th, 2019. So we'd highly recommend that you review the proposal and provide feedback to the government, and review the standards in the proposal for your sector and apply to have your sector included. So when we talk about sectors, we've included a link there to the proposal at the bottom of the presentation there, that slide. So again, I've been talking a lot about sectors. A lot of the classification for mandatory participants or voluntary participants comes down to the NAICS code, the NAICS being the North American Industry Classification System. And so when you're applying for eligible activities, it'll be on the basis of your NAICS code, so your sector, your industrial sector, as determined by your NAICS code, and whatever activities you do based on that. So you can apply to be covered as an energy-intensive trade-exposed industry. We've included the formula here. So you calculate emissions intensity by taking the direct carbon cost for the sector as a whole and dividing it by the gross value added. So if that is greater than 1%, and your trade exposure, which is imports plus exports divided by imports plus sales, is greater than 10%, then it counts as a medium or higher trade exposed industry, or if the emissions intensity is above 3%. So if emissions intensity is effectively more than 3% of the gross value add to the economy or of the industry, then it qualifies as long as any level of trade exposure is achieved. So as long as you have effectively any imports or exports of really any type at that point. So that's qualifying as an emissions intensive trade exposed sector. There's also other ways of applying. So you can apply if you show that there's a large threat of carbon leakage. So if you're producing something and your competitors would be covered under the output-based pricing standard, where maybe that's not their primary activity, but it is something they do and they're getting a carbon tax exemption for it, you can apply to be covered. So at that point, you need to know who your competitors are, and even if they don't apply to you, you should know what the output-based pricing standards are, and if they apply to your competitors. Carbon costs are large relative to sector profits or revenue. That effectively comes down to how much the carbon tax is going to cost your sector specifically versus how much it actually makes in terms of profit and revenue. Market share, so if you've got a fairly small market share and you'll be losing, there's a significant risk of losing out to competitors with larger market share who wouldn't be bearing the same kind of cost as you would be. You can apply for an exemption that way. So the inability of the sector to pass on carbon costs. So if you're trading in a market industry or say on a market index where you don't actually get to set the price yourself, so you can't actually pass along the higher carbon cost to customers. That's perhaps an example of the inability of the sector to pass on carbon costs. So effectively, if you can prove that there's no way for you to basically set your prices higher and cover for any increased costs, or high estimated indirect carbon costs for the sector. So if you do a lot of work with companies that are going to be paying significantly higher costs in terms of carbon pricing, and they'll be passing that cost along to you at every step of the process, then to avoid really penalizing your industry, they're going to give you a break on your own carbon costs effectively. So there's a lot to be reviewed here, and it all depends on what sector you're in. So the first thing we can say is know your NAICS code. The second is talk to industry representatives. I know we have some people from the in the auto parts industry online. So perhaps the Auto Parts Manufacturing Association, or the Canadian Association of Importers and Exporters. They should have a lot of this, especially trade exposure data. The Canadian Association for Importers and Exporters. I mean, there's CME, and we have some people on from the plastics industry. So the Canadian Plastics Association should have this kind of data, and so they're great contacts. Figure out who your industry associations are that will be able to fight for you on this, and will have the data you need if you don't have that data yourself. So the next slide is a list of action items. And so if you're a mandatory participant, the first thing we can say is apply or register before April 1st. That is a big thing. That is the mandatory deadline. If you haven't already done that, make sure that you're applying. Review the output-based pricing standards so that you understand what it is you're being compensated for in terms of what kinds of production you're getting compared to others in your industry against. Review then your production for 2019. Come up with production forecasts. You should already be doing this anyways, I'm assuming. But know what those production forecasts are. and actually start comparing those production forecasts to the output-based standards so that you know where your emission benchmark is, and then start preparing energy and carbon budgets for the upcoming year based on those forecasts. So if you know how much energy you're intending to use over the next year, if you know how much you're intending to produce, that'll give you a good idea of how much you'll emit in terms of emissions, and versus where the standard will be. So use the, that'll give you an idea of where you need to improve, if you need to improve, if you'll be in a good position by the end of the year or not. It'll help you track throughout the year how your performance is going compared to what you expected. And really, it'll provide incentives to actually monitor, manage, and improve based on the based on your emissions compared to the baseline and to the budget. So that's for mandatory participants. For voluntary participants, determine if you qualify under current covered activities. They were currently designed with the mandatory participants in mind, but again, look at them, see if you are covered by those activities. And again, that our understanding is that it's based on the primary activity at a facility. So if you're a manufacturing plant that does fossil fuel generation or that does cogen, it won't necessarily apply. But if you're an electricity generator that's above 10,000 tons, it would apply. If you aren't covered, determine if your sector qualifies as trade exposed, and if so, apply to be added to the trade exposed sectors list. This might involve doing a lot of digging on your data. The Environment Canada will be going through their own data and through StatsCan data to find out which sectors will qualify under this. But they also say as long as you can provide them with credible data that shows your sector is trade exposed and emissions intensive, then you can apply to be you can apply yourself, even if they don't think so with their data. As long as you have credible data that shows otherwise, you can apply for it. You should also be looking to see if there's any significant risks of carbon leakage based on the metrics mentioned before. And then it comes down to many of the similar things as the mandatory participants, forecasting production, relating production to those output-based standards, or to, if you're applying as an eligible participant, to whatever standards they devise for your sector, preparing the energy and carbon budget for the upcoming year, and track it throughout the course of the year. So that's the review for the output-based pricing system. So we'll open it up to questions here. Okay. So any questions at all?
So Jim, I just want to clarify this 10,000 tons, 2,000 GJ, 2,005, 205,000 GJ. Is that a number?
Yep.
Thank you.
So that's the output-based system. Again, it applies to anyone over 10,000 tons and in a covered or industrial activity. Anyone who doesn't meet that threshold, so anyone below 10,000 tons or above 10,000 tons, either not in a covered industry, not in a trade-exposed industry, or who's in either of those industries and chooses not to participate, is covered by the carbon tax. And that's effectively passed along by fuel distributors to end users. So anyone who distributes fuel has to register with the CRA and basically pay the carbon tax for everybody that they provide fuel to, unless that person provides them with an exemption certificate. So the carbon tax will be passed along at a rate of $20 per ton CO2 equivalent. So that works out to about 4.5 cents per liter for gasoline, about a little over 5 cents per liter for light fuel oil, 3.9 cents per cubic meter of natural gas, which is approximately $1 a GJ. And then for coal, $45 a ton if it's high heat value coal, or $35 a ton for low heat value coal. Now, as we mentioned earlier, there are some exceptions to this, and I know we have a lot of greenhouses on the line. And so one of the biggest exceptions is for greenhouse operators. So greenhouse operators will likely get an exemption certificate for 80% of natural gas fuel used for greenhouse heat. And so we've included a quote here, just because this is still in flux, that it's, as proposed by the government, greenhouse operators may not have to register with the CRA, and under the proposed relief, greenhouse operators may be able to use an exemption certificate and benefit from partial relief of the charge for natural gas and propane in specific circumstances. More details will be available in early 2019. So that is something that is still subject to change. Everything we've seen from the government so far has been proposed. They ended their feedback on that in November, and they haven't said anything since. So we are expecting this is what it will likely happen. It is not guaranteed. Now, the big thing here to focus on, especially for greenhouse operators, is that it's 80% of natural gas used for heat. So that means if you have generators that are running for peak avoidance for global adjustment, if you're a large greenhouse, or if you're using the natural gas or propane for things other than greenhouse heat, that gas is not covered by this program. When it comes to cogen, that might be a bit more difficult because you're using the heat portion of it as well as the electricity. We will be actually on a webinar with the federal government tomorrow, and so we'll be asking them just for confirmation in terms of how that applies, and seeing if they have any more detail about finalizing this exception. So there are other exceptions as well beyond greenhouse operators. Just one thing more with greenhouse operators. Under cap and trade in Ontario, greenhouses that were over 10,000 tons could apply to participate in cap and trade. Currently, there isn't an output-based standard for greenhouses. Given this kind of an exception, it's unlikely that there will be an output-based standard. So this will apply to any greenhouse of any size, but then you won't have that output-based standard. So there won't be that same kind of split between 10,000-ton greenhouses that were covered under cap and trade versus those that were smaller. This will apply to every greenhouse of whatever size, as far as we know currently. So other exceptions, so farmers do not need to register. They get an exemption certificate for farm equipment and or tractor-related diesel and gasoline. Now they have a bit more of a definition here of farming, just because greenhouses typically get lumped under a lot of the farm classification. Based on their definition of farm here, I would say that greenhouse activities don't necessarily qualify, especially since it is more related to tractor-related diesel and gasoline or farm truck-related diesel and gasoline. If you're a greenhouse with a very, very heavy fleet of tractors or diesel or gas or propane light fuel oil based vehicles, you could possibly apply for that kind of an exemption. I don't know how it'll be covered at this point. That's something else we'll be asking for clarification on. So fishers do not need to register. They get an exemption certificate for all fishing-related diesel and gasoline. Aviation fuels in the Yukon and Nunavut are charged at a rate of $0 per liter for aviation fuels. And power plant operators in remote communities do not need to register, get an exemption certificate for light fuel oil and diesel used to generate power. And remote communities are very highly remote communities. I don't think anybody on this call would qualify as being in a remote community, but we thought we'd include that in here anyways. So action items, and again, this is something that's common to everybody. You should be preparing energy and carbon budgets for the upcoming year based on your forecast. So forecast what your expected energy usage is going to be, forecast what that's going to mean for your carbon output and your carbon cost based on the information available. So prepare to pay for that, and prepare forecasts for future years. Again, the carbon tax is going to be increasing by $10 a ton every year. So prepare for that in your budgeting. Reduce fossil fuel consumption where possible. So especially for customers in Ontario that are covered under the Global Adjustment or the current ICI program, the actual cost of electricity for much of the year is fairly low, given how much of the cost for ICI participants is covered under those 5 peaks. So electrification may be a more attractive option based on current rates. Look at incentives and rebates. There are incentives for improving your electrical efficiency, for going to electrical or electricity-based options over gasoline or natural gas-based options, and there are incentives to reduce and rebates for reducing for items that will, or retrofits that will reduce your natural gas or oil consumption. So look at those incentives, look at those rebates, and find ways to reduce fossil fuel consumption where possible. That's the biggest way to avoid those carbon tax costs. And so there will likely be a market for regulated carbon offsets. If that is a possibility, find a way to generate, carbon offsets that, you might not be able to reduce your own fossil fuel emissions anymore, but if you can find ways to store carbon and get compliance instruments for them, you can sell those to large participants who need them. And then there will be federal support programs coming out for small and medium-sized businesses for the mush sector and Indigenous communities. So those will likely, those are still, as with everything in this program, in flux. We haven't actually found out what specific details and what specific forms those programs will represent. And so, as we said, this program is still being developed. If you feel like you are being missed, provide feedback on open regulations and programs, or just provide feedback to Environment Canada. We do have a link at the end of the presentation to Environment Canada's carbon pricing email. So if you need to provide them with any feedback, you can use that. So as mentioned, the federal support, the small and medium-sized businesses are expected to receive $105 million in support in 2019-2020, increasing to $25 million by 2023-2024. The Mush and Indigenous communities will get $50 million in 2019-2020, increasing to $125 million by 2023-2024. And details are still being developed, but based on what we've heard so far and what the government's saying, it looks like it will likely be in the form of additional levels of tax rebates. And so as mentioned, and I think G kind of gave it away, the answer for approximately how many GJs of natural gas emits 10,000 tons CO2 equivalent is about 2,000 or 200,000 GJs of natural gas a year emits 10,000 tons. It's actually a little over that, but we like the nice round numbers. So we'll open the lines up again for questions. Does anybody have any questions?
Will these slides be immediately viewable on your site, or will that take some time, just so that we can maybe review a lot of this stuff next time?
Yeah, we will be providing the slides. We can provide the slides immediately following the presentation. And again, as mentioned, this webinar is being recorded, so a recording will be put up on the website likely tomorrow. So we'd highly recommend going back through it. If you have any other questions, feel free to email or call us as well. Yeah.
Right. So the slideshow will be posted then.
Yeah.
Yeah.
Fantastic. Okay. Yeah.
Any further questions from anybody here today? All right, well, without any further ado, I'm going to thank everybody again. Sorry about the technical difficulties that we've had today, but I think we still got a pretty good kind of overview of carbon in Ontario. Just a reminder, we're going to be sending out a quiz right after this presentation. Once again, we will be definitely putting a recording up on this, and we will make those slides available because I realize not everybody got a good chance to see, especially the first little bit of the presentation. So thanks again, everybody, and we'll be talking to you soon.
Thank you.
Thank you.
Thank you.